A couple of weeks ago, we started telling the story of a theoretical company, from incorporation to first rounds of funding. And the idea here was to use examples to explain how the company cap table evolves and how the legal process works through all these steps. This is part 3 of Startup Funding Explained. If you haven't watched parts 1 and 2, please make sure to check them out first, because otherwise none of this stuff is going to make any sense. Okay. So a founder quits. 18 months after the company started, one of the founders in this theoretical business has decided to leave the company. This is where the vesting period that we defined will turn out incredibly useful to protect the rest of the company and the investors. According to the vesting rules that we had defined before, the founder had a 1-year cliff to get the first chunk of shares. We're through that. The 4 million shares assigned to the founder were to be vested monthly at the end of each calendar month. Since he worked for the company for 18 months, he is entitled to 18 out of 48 installments, which represent 1.5 million shares. So what happens to the remaining 2.5 million shares? Well, since they haven't vested, they are repurchased by the company at the price the founder initially paid for them. In that case, that price was $50. Now the company no longer has 10.5 million shares, it's now back down to 8 million shares, and the cap table has changed again. The remaining founder still has 4 million shares, but now they represent 50% of the company again. The investor still has 2 million shares, but they now represent 25% of the company. Again, the number of shares each person hasn't changed, but the percentages do. Series A funding. The theoretical company is doing great, even after a co-founder left. It's doing around $160,000 in MRR, which translates into $2 million in annualized subscriptions. It's still growing 10% month over month, and there's a visible market opportunity ahead. These are more or less the metrics needed to prepare for a Series A round. This time the company is looking to raise $2.5 million in funding. The company will seek a valuation of $10 million. That is 5 times their annualized revenues. Remember that valuation standard? They actually have the metrics now to justify the valuation. So a Silicon Valley venture capital firm takes an interest, and the diligence process begins. Investors will want to dig deep into the company's legal structure, agreements, contracts, financials, and the negotiation process also begins. With the convertible note, there are very few points to negotiate on, but this will be a priced round of funding. Stock will be issued to the new investors. These new investors are bringing in $2.5 million, which is, of course, a shit ton of money. They will want a say on critical company decisions. Series A funding, the board. One way to do that is with a board seat. The board of directors has control over crucial company aspects. It abides by the company bylaws, which is a sort of rule book that every company should have. Up until now, the board of directors of this company was probably not defined very formally. We had a founder, we had one friends and family investor with a small $50K investment, and there's the convertible note investors, but they're not shareholders just yet. At this stage in the company, everybody needs to trust this founder to make the right decisions, so the board is not that relevant. But now, investors will want to check and potentially adjust the bylaws to ensure that there are no loose ends. The board makes most company decisions with a simple majority, so it would make sense for the company to have 3 board members, the original founder, the new investors, and someone to break the tie. 5 would also be a fair number. This persona could be an advisor or even a senior company employee. Series A funding, preferred shares. The new investors will also want to protect themselves in case the company goes down, or if it gets acquired for less than the valuation that they invested in. If the company ends up struggling in the future, it might file for bankruptcy and be forced to liquidate all of its assets, sell the stuff it owns, maybe cars, properties, computers, even the domains and the code. Or it might be acquired or absorbed for a small amount of money, certainly less than what the investors paid when the company was thriving. In that case, investors will want to request protection. So if that happens, they can get their money out first. So let's remember, these new investors are considering investing $2.5 million on a $10 million valuation. If the company got acquired for, say, $5 million, they would effectively lose 50% of the money they invested. With a liquidation preference clause, investors can protect their cash investments so that at least they are paid out first. For example, they could request a 1x liquidation preference. So if the company is sold for $5 million, they get their $2.5 million investment first and the remaining $2.5 million are split between the remaining common stock. Special rules like this make up what we call preferred stock. Which rules, how many assurances and protections investors have, requires a very long and tedious negotiation process. This whole process is likely going to set the company back anywhere between $50,000 to $100,000 in legal fees. We won't dig into that, but that's a fairly standard number I've heard from a good number of founders. The point is, new investors are coming, they're bringing $2.5 million in new capital, and they've agreed to this $10 million pre-money valuation. Let's assume negotiations are done and the round is happening. Let's see how the cap table changes. Series A math. Okay, so before the Series A investors come in, we have the convertible notes, and they're going to get executed because there's a new round of funding. So remember, there was a $500,000 investment that will be converted. And in this case, we're going to use an $8 million pre-money valuation. Why? Because that's the $10 million valuation that the new investors defined minus the agreed 20% discount to compensate investors for coming in early. All the other terms agreed will be the same as the Series A investors. That includes the preferred stock, for example. So the convertible note investors effectively avoided the whole preferred stock negotiation process. They simply trusted this new institutional investor to get a good deal, and they just piggyback on the same terms. Coincidentally, the company now has 8 million shares. So this is the simplest math you'll ever get. We just need to issue 500,000 new shares of stock for this new investor. The price per share is exactly $1. The company now has 8.5 million shares of stock. The convertible note investors own 500,000 shares, which represent around 5.9% of the company for now. Now it's time for the Series A investors. Now, before they invest, they requested the company to create a new option pool for future employees to come. Also, a founder quit. So the company needs to have some stock option pool available to bring in a new key employee. This person won't be a co-founder at this point. The company is founded and it has a product and it has good amounts of revenue, but they will be a crucial part of the business. So Series A investors have requested the option pool to occur before their investment because they don't want those shares to come out of their end. This is pretty much a standard procedure. This new option pool will again be 500,000 shares. That represents 5.56% of the company as of today. However, there's a major difference with this option pool compared to the last one. The company has a new, fresh valuation. While the first option pool was created when the company was worth just $250,000, the business is now worth, on paper, because of the investment, it's worth $8.5 million. It has issued 8.5 million shares. That means the strike price for this new option pool will be around $1 per share. The point of all of this is our theoretical business is going to get acquired. So we'll see how much money each one of these option pool holders will get. All right, so this is how the company looks after the second option pool is created. Now it's time for the Series A money, finally. So investors, again, agreed on a $10 million pre-money valuation. The company now has 9 million shares of stock. That means that they're valuing each share at $1.1111 infinite dollars. So with their $2.5 million investment, they are going to purchase shares at that exact price. So the formula looks something like this: shares issued divided by company valuation times the new investment. 10 million divided by 9 million multiplied by 2.5 million, that's 2,777,777 shares, 0.77. So effectively, we're going to round that up to 778 shares. And they'll need to be issued to the new investors. We can't have decimal shares, so this needs to be rounded up. Luckily, remember, we incorporated with 10 million shares of stock, so those decimal positions aren't worth a lot of money these days. The company will now have a total of 11,777,778 shares. And this is how the cap table looks like. Series B and Series C. I have never done a Series B or Series C in my life, but the process is quote unquote similar. It's certainly more expensive, it's more complicated, more people involved, more complex terms involved, but the essence is the same. Companies like Pinterest, for example, have raised up to Series F, so you can imagine how complex that cap table gets. We're not going to dig into that. But in our next and final video, we'll look into the company exit. This business, like I said, will get acquired, and then we'll figure out the logistics and especially how much money everybody ends up making. We'll see you next week.